in there. Let's hear it out from the L&T management. They just came out with the numbers, the buyback announcement as well. Avan just had a chat with the management.
Biggest advantage that we have as we started the year was a very healthy order book. Nearly 4 lakh crores of orders meant that we had to get on to fast track in terms of execution. And as you know, in our industry, we work under the skies, and April, June is a good quarter because we do not have interruptions of monsoons, etc. So generally, I think we get quickly on to completing projects in the first quarter. The biggest driver, if I may call that, is most of these projects are marquee projects, and they are under supervision of either the world financing bodies, multilateral agencies, or they are priority projects for the government, both state and center. So the extent of oversight and the support that we had received has also been very, very encouraging. And this has helped us move ahead. And as you know, we're just possibly leaving the COVID impact behind. So we've been able to mobilize resources in our various project sites and get going on that front. So that's been the real reason for the revenue growth. As far as EBITDA, it's a function of the volume growth that we've been able to achieve on the top line. Profitability is something that we are working on because I think there is room for us to improve. We are still absorbing the effect of inflation of the post-COVID, post-war period. But I guess through the course of this year, we'll slowly get that out of our charts. And we expect 24-25 to be a much better year.
All right, good to know. Mr. Raman, given the fact that we've seen domestic execution pick up, that as well has contributed to your margin improvement. By when can we see the completion of legacy projects, and in turn, where do we see your margins headed?
See, I think if you look at our mix of orders, out of 4 lakh crore of orders that we started the year with, nearly 2 lakh crore worth of orders were picked up during FY23. Now, FY23 was a period where we could afford to factor in the inflation prices, etc. So to that extent, I think the ability to have anticipated the price trends was better. What really we call it as legacy is the projects that we picked in 21, 22. Now, these were picked up at a time where the inflation was raging. It was becoming a big task to predict the cost lines over a period of 12, 24 months. So as most of us normally do, we did our best estimate and went into the contracts. When we execute the contract, the commitments that we have made for various sourcing actually starts coming through in the subsequent quarters. Being a project business, there's a lead lag between the time we commit for the inputs and supplies and when the supplies actually come in to our project sites. So I think what we are seeing in the last 2 quarters of FY23 and the current quarter that we just are reporting have seen the impact of this cost inflation. We do expect the next 2 quarters to have the trailing effect of these cost inflation. I do believe from Q4 of the current year, the mix of orders that we are executing will become a little more biased towards better priced contracts. So to that extent, I think the last quarter of the current year and the next 4 quarters of the following year should indicate improvement in our margins.
Now, you know, in your overall prospect pipeline, we've seen hydrocarbon be the key growth driver. Do you think that hydrocarbon as a segment, along with heavy engineering, will continue to see improving margin trends?
Hydrocarbon, almost 60% of the projects that we have won in hydrocarbon is projects that we have won overseas. And what happens in overseas projects is they intrinsically are much larger in scope and size. And that gives us advantage of working with larger global supply chain. And the scale effect also comes into play. So the ability to work on larger projects gives us that advantage as compared to the Indian projects, which are far lesser in size. whether it is small project or large project, it is our duty to make sure that we put the best team to work at these various project sites. So the ability to absorb costs in larger projects is that much better. So we do expect the margins to be stable. I don't expect hydrocarbon margins, which as it is are healthy, to run away much beyond where we are. But I think we would be able to operate around the levels that we are currently reporting. The first quarter, we reported hydrocarbon margins around 9.1%. I think working in a band of nine quarter is a good place to be in as far as hydrocarbon is concerned. As far as heavy engineering is concerned, this largely supplies equipments custom made to clients' requirements, mostly to heavy hydrocarbon industry as well as to nuclear industry. Intrinsically, manufacturing operations has a better margin profile because of the entry barriers are pretty high, and we have over 30 years of experience in working in some of these process technologies and complicated engineering technologies. So I think we do believe that the margins of mid-teens for manufacturing activity of hydrocarbon equipments through the heavy engineering business will sustain.
Can't help but also discuss that mammoth 10,000 crore rupee buyback that the company has undertaken. Given that you desire to reach an ROE of about 18% by FY26, riding on this, will we see much more distribution in the form of buybacks, special dividends down the line as well? And if you'd like to elaborate a little bit more on the buyback.
I think this buyback has been part of the program that we have set ourselves for in this ROE improvement journey. So it's part of Lakshya 26, the 5-year strat plan that the company is working on. We had to make sure that we are in compliance of the regulatory requirements. Last time over, when we attempted to do a buyback, there was certain ambiguity in the regulations, and hence we could not complete the program. But we had subsequently worked with SEBI to make sure that necessary clarificatory guidelines are in place. Today, we think that what we actually started thinking of doing 3-4 years back, we're beginning to get on the track with that. If you really see, our business generates fair bit of cash. We are not very capital intensive by nature. We are more working capital intensive, which is short-term cash flows. And if the company continues to win impressive orders, execute well and profitably, the ability of the company to generate cash on a consistent basis is high. It doesn't have much of debt on its balance sheet. If you set aside the financial services business, there's not much of debt that L&T as a group has at all. And particularly the standalone company of L&T has about 20,000 crores of debt, which is pretty modest when you compare the size of operations of the company. So all the cash flows that accumulate either needs to be done for investing in new areas or needs to be returned back to the shareholders. Investment in new areas, we have got to be very selective because we, over the last 10 years, have invested in certain areas which actually have not produced the desired returns for the shareholders. The concession assets, for example, that we invested big time in, did not really produce the desired returns, and hence we are in course of divesting those businesses. So I think given the selectivity on investment, our thinking is that we will possibly invest somewhat in LNG transition, in hydrogen related business. So we are setting up a electrolyzer manufacturing facility for making electrolyzer equipments, which helps actually manufacture hydrogen. We do think that areas such as those, which are futuristic, is where we would like to invest. But in any case, as a strategy, we are looking at asset-light, return high areas of operations. So consequently, I think the cash that gets generated beyond the requirement of the company is meant for shareholders. And that's the path we will take. Returning money to shareholders can take couple of forms. Obviously, dividend is one obvious way of providing return back to the shareholders. A buyback is a good way, and buyback will not happen as regularly as dividend, which is an annual feature. But I think once in a while, when we are able to accumulate sufficient resources, cash surpluses, I think buyback along with a normally healthy dividend rate will be the way to go.
Right, point taken. You've also largely maintained your guidance, but given the fact that, Mr. Raman, you have seen a strong order pipeline, there is expected lumpiness in the ordering environment during the pre-election period, don't you think it's more on the conservative side? Will you relook at this, look at perhaps a revision on the upside?
We tend to review the guidelines, guidance that we give to the market once in 6 months. So we do think that we gave the guidance for FY24 in the month of May when we announced our results. To come back and tweak the guideline in July seems a bit premature. We are happy and fortunate that we've got off to a very good start in the current year. But as you know, there are 3 more quarters that we need to perform. And uncertainties is part and parcel of our business life. So we just want to make sure that we assess the conditions. We don't want to be seen as somebody who keeps reacting to quarterly developments. We want to be a little more stable. Inherently, we are a conservative company. We do believe that we need to actually deliver on our performance. So I can't escape the dose of realism in whatever we commit to the markets. But having said that, as you rightly said, I think we are operating in a project business which is very lumpy and non-linear. So who knows? I think if their conditions are such that gives us confidence that we should be able to revise the guideline, we would do this. But the fact is, maybe one more quarter down the line would be a little better time to even debate about this.
Okay, that's the interaction coming in with the L&T management. Let's just quickly